Okay, so for question 6.3, we also have to work out, let me just scroll to the bottom, the income tax payable. So income tax payable would be your tax liability after any prepaid taxes or any provisional tax. Now, what they said is you may ignore provisions of section 84E, which is your recoupment, and paragraph 8 schedule, which is your capital gains. So you can ignore it for this question, but we have included it just for completeness sake. Okay. So in this question, they don't want you to do it, but we have included some of it. Okay, so let's go through the question, see what is the important things you had to note. So the first thing you had to see in the opening paragraph is this company is a small business corporation. It has a year end of 31st of July. So because it's 31st of July, it means our year would run from 1 August up to 31st of July. Okay, now if you read small business corporation, what does that mean? What do you need to look out for? Small business corporation, there's two things that needs to go off when you read small business corporation. What are the two things you need to see? Okay, so that's correct. Section 12E is applicable. And then the other thing is the SPC tax rate will be used when we work out liability at the end. Okay, so that is something that needs to go off in your mind once you see that information. Okay, then they give you a table with receipts and expenditure. Now, what I would suggest you do is we would normally start with the ones that don't have notes, and then where it has a note, you would go to the further information to see what information have they provided so that we deal with that specifically. So the first thing is they've given you sales and then they've given you local dividends. If you see local dividends, what do you need to do in addition to just including it in your gross income? What is the second step when you see a local dividend? Okay, if you see local dividends, what little flag needs to go off? What flag needs to go off if you see a local dividend?
Ma'am, isn't it whether if it's import or export exempt?
Okay, now remember the import-export has to do specifically with the VAT component. When we see local dividends, what you need to make a note of is it is also exempt from taxable income. But as soon as you see exempt, what I want you to do is you include the amount under your gross income and you include a deduction under your exemptions. Okay, so you can see here, based on my notes, you will show it at two places. Why do you have to show it as two places? Because you will receive 2 marks for it. So the one is where you physically bring it in, and the other one is where you show, but it is not actually taxable, so now I'm taking it out. Okay, so remember to do that in the exam for me, because you actually get marks. In the test, I've assigned marks if you gave me a 0 and you wrote there the amount is exempt, but in the exam, if someone else needs to mark it, you need to include it and exclude it to get the marks. Okay, then we've got receipts from the sale of the machine. So let's quickly read the receipts and then we will account for that information so long. So they tell you machine super safe was used in the process of manufacturing. Okay, so it's used in the process of manufacturing, and the machine was no longer meeting the expected output, so it was sold on 20 June 2021 for 552,000, and the machine was purchased second hand 30 September 2020 for 570,000. Okay, so it was purchased in the year and we disposed of it in the year. Okay, so based on our tax year. So that means in terms of section 12E, we would have 100% deduction in this year for the capital allowance. But because we then disposed of it for more than what the value was initially, we also have a recoupment. Okay, so that 525 is less than the original 570, so we do not actually have a capital. We haven't sold it for more than its cost, so our recoupment would be limited to the 525, and if we then work out the capital gains, it would also be a 0. So let's quickly see what the other information is in here. They also say the super safe machine was replaced. Okay, so we replaced that machine with machine triple super safe, and that cost us 1.2 million, and the supporting structure cost us additional 120, and the installation cost also 50,000. So we said when we do the original cost, we add any installation and structural costs to the value. Okay, so we have to update the value for the cost, and then we get a section 12E deduction as well for 100%, because this machine is replacing the super safe one, which is also used in our production or process of manufacturing. Okay, so I'm just going to stop sharing here, and then I'll share the Excel file. So let's then complete the Excel as we go along. Okay, so the first thing we said is we bring in the sales. So in this scenario, we've just got normal sales, so you include the 5 million for the sales there. If they tell you there's local and foreign sales, then you would have accounted for the local and foreign sales separately, or you could say sales and just add the two amounts together, and I would have assigned the marks. Then for point 2, we said you include the dividends. So you see here, I've included the 200,000, but because dividends are also exempt, I then deducted. So that's what I mean with you included as well as excluded. You show both the in and the out for me to make sure you get those 2 marks. Okay, that is very important for your test or for your exam that you are going to write in December. Then for the machine, so the machine, we start off with the deduction that we get, and then we work out the recoupment based on that. So for machine super safe, we say the original cost for that machine was 570,000. The deduction we would have received in our year in terms of section 12E would have been 100%. Okay, so we got that full 570 as a deduction in this year. So our current tax base for that asset is actually 0. Now, to work out the recoupment, we say, okay, fine, our proceeds is 525, okay, which is limited to the 570. So we cannot go to more than the original cost. Now, in this case, because the 525 is less than the original cost, we will apply the 525. Our tax value is 0, so we take the 525 less 0 gives us a recoupment of 525, which we include in our taxable calculation. But then we have to go look at, is there any capital gains tax relatable or applicable? So we first start with the proceeds. So we take the 525 less the amount that is included in recoupment, which means that our proceeds is 0 for tax purposes, for capital gains tax, and our base cost is the 570 less the 570, which also gives us a 0, which means we do not have any capital gains. Okay, so the capital gains in this scenario is actually 0. But then we said we now replace that amount with a new machine, which was the triple super safe machine. Okay, now the original cost for that was, let's quickly see, it was the amount was the 1.2 million plus the 120,000 plus the 50,000. So you add all the additional costs which you've included to get to that amount. So you take the 1.2 million, you add the 120,000, you add the 50,000, and because we still acquired it in that same year, you deduct that full amount in the current year. Okay, so you see we actually get 2 deductions, but because we disposed of the one, we also had a recoupment for the other asset. Okay, so that is up to note 1. Before I move on, do you have any questions up to this point? Are you guys okay so far? Okay, so I'm just going to stop sharing here and then I'll share the PDF again with you guys. Okay, so then if we go on, we tell there's a receipt from sale of motor vehicle, which is point number 4. Then stock was under point number 2, so we're going to start with the stock under point number 2 and then the purchase of the motor vehicle. And then we'll move on to point 4. Okay, so they tell you the closing stock was 200,000, the opening stock was 150. So we said for tax purposes, closing stock we added back, whereas the opening stock we deducted from our calculation. Okay, then we've got purchases for the year amounted to 715,250. Okay, so the purchases we deduct as well. And then we tell you trading stock with a cost of 2,500 was removed from stock. It was donated to the local police station. It had a market value of 5,000 Rand and it did not qualify as a Section 18A donation. Okay, so based on that information, at what value will we recoup the stock that we have donated? At what value will the recoupment be? Based on the information provided. Okay, so Marentia says at 5,000 Rand. Okay, so that's correct. It will be at the market value. And the reason is because it is not a qualifying Section 18A organization. So for that reason, we will use the market value when we do the recoupment, and that would also mean we do not get that additional deduction at the end. If we move on to point number 3, we purchased a new delivery vehicle on the 1st of June for 500,000. And they tell you the binding general rule allows for a write-off for trucks over 4 years. Okay, so you can write it off over 4 years, but because of the fact that we are a small business corporation, we can also apply Section 12E, which says it is 50, 30, 20% rule. Okay, now based on that and the 4-year write-off, which one of the two do you think will be the more beneficial for the company? The 50, 30, 20% rule or the 4-year write-off? What do you guys think? If I, as the taxpayer, have a choice between applying either the 50, 30, 20% rule or the 4-year write-off, which one do you think will give me a bigger write-off quicker? Okay, based on that information, which one do you think will give us the bigger write-off? So remember, if I do a 4-year write-off, it is essentially 25% per annum. If I apply the 50, 30, 20, I get 50% in year 1, 30% in year 2, and 20% in year 3. So I'm writing it off over 3 years. So in this scenario, I would rather want to apply Section 12E because I will be able to write off that asset quicker. Okay, so in this scenario, you would rather do 12E. Now, if we look at number 4, the CEO was driving a Mercedes. The car was purchased and sold in the current year of assessment. It was purchased for $789, including VAT, and was sold for $200,000. Okay, now remember, for VAT, if it is a motor vehicle, input VAT will be denied. So that means we will apply the full $798,000 when we apply it, and we will apply the 50, 30, 20% rule, and then we also will have to, because we sold it, we'll have to look as the recoupment or a scrapping allowance. Okay, so that is what this information tells us, and then the last bit of information tells us the provisional tax payment is $289,000 for the year, which we take into account after we've worked out the normal tax for the year to work out the tax payable. Okay, so I'm quickly going to stop sharing here, and then let's just finish this question. And then we are done for today. Okay, so we said opening stock, we deduct, closing stock, okay, purchases we deduct, and closing stock we add back. Okay, so that was the information they provided. Then we said for the donation of stock, because of the fact that it's not to a PBO, we will recover it at the market value because it was not a Section 18A donation. Then for our new delivery vehicle, what we will do is the deduction will be based on the 50, 30, 20% rule. Because it is year 1, we will apply the 50% rather than the 4-year period, which is the alternative. Then for the Mercedes-Benz that on our expenditure and payments, there was water, electricity, and salaries and wages, which we can just deduct based on the information provided. So the water and electricity was $125,000, salaries and wages was $200,000. Then we had a personal motor vehicle for the CEO. Now, because we sold it, you have to work out if there's a recoupment. Now, because of the fact that this Mercedes-Benz was purchased in the year and input VAT is denied, we would have applied the full $798,000, and our write-off or the allowance would have been 50% for year 1 because it is a non-manufacturing asset, which would give us a value of $399,000, which we deducted, which means our tax base for this asset is also $399,000. Now, to work out the recoupment or the additional allowance, we will start with the proceeds. The proceeds for this asset. Okay, sorry, let's just unhide all of the information here. So the selling price was 200,000. Now, because our tax value is more than the 200,000, we take the 200,000, deduct our tax value, and that means we get an additional deduction of 199,000. All this information means is that 200,000 is limited to the original cost of 799. Now, because the 200,000 is less than that, we apply the 200,000 and we then deduct whatever the tax value is to get the additional scrapping allowance. Now, just for completeness purposes, the capital gains tax, our proceeds would be 200,000 and the base cost would be the 798,000 less the tax value, less the additional scrapping allowance would give us a base cost of 200,000, which means there is actually no capital gains. Then we add all of that to get to our taxable income, and then we apply our SBC tables to get to our tax amount for the year, and we deduct the provisional tax payment to get to our tax payable at the end of the year of 106,000. Okay, and that is how you would do this calculation. Okay, do you guys have any questions on this?